So our second discussion this week is about risk and insurance. The process of risk management actually begins with the definition of risk. So risk is the uncertainty about an income, about an outcome. So think of it like this. Say you bought a stock. The stock price can go up or down. So your risk is the uncertainty of that stock price going up. Same thing applies to, say, you buying a house. The price of the house can go up. The price of the house can go down. Therefore, you're actually taking a certain amount of risk based on this uncertainty. There are two types of risk. The first one is referred to as speculative risk, where you have the potential for gain as well as loss. So when you buy a stock, you basically are doing is you're taking a speculative risk. When you buy a house, you're taking a speculative risk. Pure risk, however, is defined as there's only the possibility of loss. There is no potential for gain. So this is more, the risk that is associated with liability. So we'll talk about it in a minute. So part of the second step in our risk management is identifying our risk exposures. In any event that actually causes a financial loss, we need to know what they are. So it can be, quite tricky, actually. We may not envision how we could face such a financial loss. However, we have to be thorough. Anything and everything that actually can become a financial loss, we need to be able to identify them. The liability becomes an issue because there are a lot of liabilities within our legal system that one can be faced, including owning a home, owning a car, even with our day-to-day lives, we actually have financial liability that we need to identify as our risk exposure. We need to, after we make that identification, we need to estimate the amount of risk we're taking and potential financial losses we could incur. How much of a loss we can incur, what is our loss frequency, and the severity of loss, we need to estimate it. So basically, we're going to define the type of risks that we have, write it down, and then identify anything and everything that could actually expose you to a financial loss. And then we estimate how often they can happen and what type of potential loss you could incur with each and every exposure that you've listed. Then we choose how to handle that risk. We could try avoiding the risk. Like, for instance, it may sound silly, but it is what it is. If you don't want to have the risk of financial liability because of a traffic accident, you may choose not to drive, not to own a car. You could just take a taxi or take public transportation. So instead of having the liability of somebody slipping and breaking a leg in your driveway, you could live in an apartment that doesn't have a driveway. Again, it may sound silly, but there are obvious examples of avoiding risk. So, for instance, if you are going to be, considering to buy a car insurance, you may want to, look around what type of cars would have a lower risk and therefore lower insurance premium. So, for instance, I drive a Volvo, and that actually has a lower risk, and therefore I pay a significantly lower insurance premium compared to my previous car, which was a Toyota Corolla. So, the risk avoidance can be reasonable and can be detailed. So the risk retention is another way of handling risk, and an example for this would be getting an insurance deductible. This would make your cost of insurance quite manageable, and small risk you could pay it out of pocket, and the larger risk you could actually have an insurance for. You could control risk, and perhaps we should talk about these three altogether. We could transfer risk and we could reduce risk. So think of it like this. When I was in college, the university offered some sort of a health insurance, and this was a long time ago, as you can tell. but the university offered a health insurance, which was not preferable for me, and I really needed a real health insurance. However, it was very expensive, and I couldn't afford it. So I looked at ways of getting this health insurance a lot cheaper. So I took out a health insurance that actually had a $5,000 deductible, which was significant. But I wasn't worried about, getting the flu or, falling and, spraining my ankle, because the university that I went to had health services, and that basically made it a little easier for me to go to a hospital. However, and the insurance through the university was quite efficient when it comes to small things. So it was the bigger things that I was worried about, cancer, a heart attack, an aneurysm, or things that would actually cost significantly more than $5,000. So my way of transferring the risk was getting insurance. I transferred my risk of being exposed to incredible financial costs of getting sick. Was basically, I transferred this risk to an insurance company by buying a health insurance. And I controlled the risk, and I reduced the risk by buying this health insurance with a high deductible, so that the smaller risks I could actually take it by myself, meaning that I could have a health savings account of, say, $5,000, and then any health costs that I would need to pay, I would pay this out of this health savings account. But anything substantial, then insurance would kick in. So after we identify our risk, after we estimate the risk and potential losses, and we choose how we're going to handle it, then we implement the risk management. We shop for insurance. We find for different ways in which we can actually get our insurance. If we choose to avoid risk, then we make proper changes in our lives or in our risk exposure. If we choose to reduce risk, then again, we change certain things in our lives or in our risk exposure. And it's quite nice to, and quite indicated to, evaluate and adjust our risk management quite periodically. I personally do it every 6 months when my car insurance is due. It's just an opportunity to evaluate my entire insurance and entire risk management. And overall, I basically look at anything and everything that I'm financially exposed to, and try to manage it all. So what's an insurance? Insurance is a way to reduce risk. You cannot eliminate risk completely, but you can reduce it through insurance. We pay premium to buy insurance. However, I have to emphasize this. You actually are not buying insurance. You apply for insurance, and the insurance company evaluates your risk, gives you an offer, or makes you an offer. And then if you accept the offer, then they underwrite your insurance policy. So we pay insurance, and we get insurance to reduce risk. And the insurance, once we agree to the terms, we basically get an insurance policy, which is our insurance contract between us and the insurance company. So that policy basically, I'm sure that you've seen it for your car insurance, how thick and how fine print that is, but it actually is pays to read it. You should know what specific clauses are, and how it applies to you, and you should know your risk exposure. Any unexpected financial loss could be devastating. So note that only certain losses are insurable. So they have to be fortuitous in nature, and they have to be financial loss. So for instance, my wife sent me a box when she was at a vacation, and it basically contained some books that had sentimental value for us. And when she wanted to put it in UPS, they asked what the value is. And my wife said, for the book, it's probably less than $10, but sentimental value, it's priceless. Unfortunately, that sentimental value, you cannot put it down as a financial loss. So it needs to be immeasurable. It needs to be an actual financial loss, and it needs to be fortuitous for it to be insurable. So there's the principle of indemnity. This will limit the insurance payout, and there are several ways of reducing the insurance cost, obviously, and like I talked about before, a deductible is the most common way. So, when you're getting a car insurance, think about like how much of a cost you are willing to pay out of pocket, and then how much do you really need to be insured? Because if you get a zero deductible, the premium that you're going to start paying will be substantially more. So perhaps setting aside $1,000 in a savings account and dedicating that $1,000 for this purpose, in the long run, would actually pay you in lower premiums. You could get co-insurance. And sometimes, like for instance, for health insurance, you could get a health insurance and you could get a secondary health insurance. And this seems to manage some of the risks and some of the costs associated with insurance. But co-insurance is one of the ways to reduce insurance cost. You could lower your hazard reduction. So for instance, years ago, when I go back and forth between insurance companies depending on who's offering the best value, and Progressive offered a very good value by giving me a little device that I connect to my car, and they basically follow how well I drive. And me knowing that they actually had this device in my car, I started driving a little better. So I always consider myself to be a safe driver. However, knowing that this device measures hard brakes and too fast of accelerations and so on and so forth, I basically, if I was following my progress on the internet and on their website, and then the first week I had 3 hard brakes, and then the second week I had none, and then I kept it for as far as I remember, I kept it like 3 or 4 months, and after the first week, I had no hard stops. So the hazard reduction, actually, an example would be like that. So another perhaps would be for, say, fire hazard. You could have, sprinkler system in your home that would actually lower the reduction, lower the cost of insurance because you have sprinkler systems against fire. You could have a burglar alarm in your house that would lower the hazard and therefore lower your insurance cost. You could have a car alarm and that would lower the cost of your car insurance. You could have certain, you could live in a gated community, for instance, that would also lower the cost of insurance. You could lower your losses, potential losses, and that would also increase your cost. So again, this may sound a little silly, but instead of living in a $500,000 home, you could live in a $300,000 home, and that would lower your potential loss. Instead of driving a $100,000 car, you could choose to drive a $30,000 car, and that would also reduce your loss. But there are certain loss reductions that are quite reasonable and that could be considered as part of your insurance cost management. The essence of insurance is sharing losses. Basically, think of it like thousands and thousands of people getting together and basically paying a premium into a company and having this company pay in the event of loss, of financial risk. So since we're sharing our losses, law of large numbers will basically determine how predictable our exposure is, how predictable our financial loss is, and therefore reduce the risk for the entire pool. So the essence of insurance is basically us, again, thousands and thousands of people, in the case of larger insurance companies, millions of people getting together, paying premiums into a pool and getting money in case of a financial loss. And obviously insurance companies work for profit, but the idea is that the bigger the pool, better the prediction, and so bigger the pool, better the prediction, and lower the risk. So larger insurance companies seem to fare well with respect to their predictions, and then therefore they're able to give you a better premium and therefore make your cost of insurance cheaper. So, like I said, insurance is applied for, not bought. Insurance companies actually evaluate your risk. They can also check your credit history based on your age, your education. They basically decide whether they're going to underwrite an insurance policy for you or not. And they may not. They may just decline your coverage. Preferred applicants pay lower rates, and just because you're older doesn't mean you're preferred. Just because you're younger doesn't mean that it's unacceptable. It depends on several factors. The insurance is a very specific field, and if you wanted to, know more about this, perhaps you should consider looking into taking an insurance class. But there are a variety of ways. For instance, I found out years ago that if you buy a red car, that actually may have a higher premium. So, considering that even a color of a car can determine or can have an impact on the premium of insurance, imagine what else goes into that function that determines the premium. So, going from age to credit history to education, the neighborhood that you live in, the city, how much you drive, and in the case of a home, how likely is it that it's going to burn down? How likely is it that it's going to get burgled? How likely is it that things are going to happen, and so on and so forth. So preferred applicants pay lower rates, standard pay standard rates, substandard pay higher rates, and then there are unacceptable applicants insurance companies simply will not touch. So insurance is typically sold through insurance agents, but an insurance agent can be independent. So they could actually represent several insurance companies, or they could be exclusive insurance agents. Now, I found in my own experience that independent insurance agents will find you cheaper policies, not necessarily the best policies. However, exclusive insurance agents may try to write you policies that you may not need, so they may try to overinsure you, and yet because they are bound by a single company, they may give you higher rates. So, it's not possible to say one is better than the other. You should do your homework with respect to how much risk you have, how much you want to insure, and what do you really need, and what sort of deductions you're going to do, and then search for that specific policy. In which case, whether the agent is independent or exclusive should not make any difference for you. In fact, in which case, independent insurance agents can actually get you multiple prices all at once. All I'm saying is, if you are in need of a specific policy, don't let anybody else to deter you for a worse policy that's not going to cover you all that much. And don't let anybody steer you into a overpaying for overinsurance and for insurance that you may not need. So there's a specific policy that's for homeowners, which actually is a combination of two separate protection. One of them is for property and the other one is for liability, because when you own a home, you're worried about your property as well as you're worried about the liability that you may be exposed to. Liability refers to, well, right here, it says, based on the harm potentially caused to others. So think of it like this. Somebody comes to your home and slips and falls, breaks a leg. Well, as a homeowner, you're liable. There was a case years ago, don't remember which state it was, but a burglar broke into a house and then fall onto a very sharp knife and incurred significant bodily damage and sued the homeowner and won. So there's liability when you own a home. So you want to have liability protection, and homeowners insurance provide that protection. So how much coverage do you need on your dwelling? So think of it like this: if a house, say, storm hits, house is dead, and they're going to do a demolition. So is it going to be a replacement cost, or are you going to get a new home? But the foundation is solid. You're just going to demo what's above the foundation and then build another one. So it depends on what type of dwelling that you have, obviously. But the cost, you should look at how much does it cost you to replace what you lose. However, having said this, mortgage companies will probably determine that for you. So and they're going to have a minimum required insurance that you would have to take. So probably this decision won't be yours to begin with. How much coverage is needed on your personal property? Now, this probably will be your decision. The cash value or the replacement cost. If you put a lot of cash value in the house, in the contents on the personal property, then your premium will be high. Replacement cost of certain things like TV or fridge or certain appliances, then your premium will be manageable. But again, in a lot of the cases, think about self-insuring. Set aside some money in case certain things happen. However, anything that you cannot afford to lose or replace may be worth putting onto your policy and paying premium for it. So how much coverage is needed for liability losses? High limits are recommended because within our judicial system, millions of dollars can be awarded to people who suffer on your property, and you may be held liable for those financial losses, and you may have to pay. What you pay is not limited with what you own. They could actually garnish your future wages, future wealth, and therefore, sky's the limit. However, obviously, it will be, you don't want to have too much of an insurance where the premium will become unmanageable. On the other hand, you want to protect yourself so that if things happen, you won't lose all your life savings and your rest of your life paying for a financial loss that was above and beyond what you thought it would be. Usually, the liability losses, the extra cost is manageable because the odds of such larger losses is low. So, going from $100,000 to $1 million is going to cost you probably a little bit more, but going from $1 million to say 2 or 3 is not going to be linear. It's not going to be exactly the same increase that you had going from a small to a large number. So additional limit may not cost you as much as you thought. Therefore, it is always advisable to incur as to the cost of obtaining additional insurance. So this is our discussion about the insurance. Your textbook also goes through auto insurance, and that's such a lengthy topic. I'll leave that, and it changes significantly. So I leave that to the textbook to provide you those details. And I tried to eliminate many of the questions on the quizzes related to auto insurance that are too detailed. So, but other than that, if you have questions, please do let me know. And if you have any topics that you'd like me to record a video for, please let me know. Thank you.